Hey everybody, Brian Shannon here from alphatrends.net. Today's Friday, the 14th of February, 2014. Let's take a look at these markets here. We had a great week for equities. The S&P was up 2.5%, NASDAQ close to 3%, as was the Russell 2000. Semiconductors up 4.2%, and the gold continued higher as well, leading the year-to-date gains with 9.5% here after adding 4% this week. So let's take a look at the charts and see what we had happen here. As you know, one of the big themes that I harp on is that we never know what resistance is until after the fact. We have potential levels of resistance, and that's what I talk about. That early, coming into this week, we were looking at this as a potential area of resistance, but the market obviously ran through that. There was no resistance there. So people who look to sell short at what they perceive to be resistance, if you're not able to very quickly cover, and obviously that's one of the things that I talk about all the time as well, is being able to be flexible in your opinion of the market. If you're looking to short at what you perceive as resistance, what you have to do is wait for the market to actually distribute and then decline, and then we would have gotten bearish if this the market made a series of lower lows and lower highs below a declining 5-day moving average. But instead, what we saw was a continuation of the recovery off of that pretty tough sell-off we saw for the in January leading into the first week of February. And we came into this market this week looking at it as innocent till proven guilty, because we had a rising 5-day moving average, and we had been looking also for the potential of resistance at a number of levels, this one being the bigger level that we thought was the potential to act as resistance for the S&P 500. But obviously we had on Thursday a brief pullback in the morning, and the market just ramped higher from there and continued to squeeze any shorts. So where do we go from here is the question, of course. The S&P 500 is just a couple percentage points away from its all-time highs here, so it's tough to be bearish. Obviously, we saw that this market bounced from that trend line very hard, also at the 150-day moving average. So a lot of times what we see is the 50-day moving average will hold as support, and then the 100, and then as the pullbacks get a little bit deeper, it's the 150, and that's part of the market slowing down overall after this several year advance that we've seen. But there's no sign of a bigger top being put in here. We've got a primary uptrend, and now what we'll look for is any pullback. We would expect that 180 to basically 180 and a half would be our primary area of support. Ideally, what we would like to see is that this little band of prior support in here, which did act as brief resistance, would act as support. So 182-ish is our first important area next week, and that's what we'll be looking for to hold. If it does that, then we remain innocent until proven guilty. It would be nice to see maybe some digestion of these gains through time a little bit, but time doesn't wait for the buyers here. We've got a runaway market basically that's still showing this pattern of higher highs and higher lows. So you have to be looking at, as always, risk management. And coming into this week, again, we were looking at it as innocent till proven guilty, but with an eye of suspicion, because we had been below that 50-day moving average, which had the potential to be resistance. This had the potential to be resistance. So again, support broken tends to act as resistance, but it doesn't always do that. What we want to do is we want to look at that prior level of support and say, is there evidence that the buyers are actually disappearing and that the sellers are regaining control? And we didn't see that, as again, in the intermediate term, we look at it as innocent till proven guilty as long as we're above the rising 5-day moving average. So the NASDAQ was up again here today, and this market is at highs for the year once again, and obviously year highs not seen since the year 2000. So the bull market continues to march higher here, and just taking the short sellers out in body bags, really. This was our bigger potential level of resistance this week, and then we looked at this as a potential level of resistance, and then we looked at the highs as potential resistance, but the resistance simply wasn't there. All that means is the sellers did not have enough firepower to overcome the buying, and it didn't pull back. So we look at this market and say, we're not trying to predict necessarily what is going to happen, but we want to be aware of key levels and say, here's a potential area where the market can counter resistance. So we want to be a little bit more aware of the potential for that resistance and be more cautious. But really, if you look at the stocks on an individual basis, there were some fantastic winners this week. I mean, we had a dozen or so really good winners in Alpha Trends, and it comes down to what is the health of what you're actually trading. You can look at all the comparisons of what historically might have happened, and that 1929 chart got around a lot. Those are very interesting charts to look at, but it's not a blueprint for what's going to happen. It's always different, and what we have to do is focus on risk management. That's job number one. And in the NASDAQ, where we're at these highs for the last decade or so and such strong momentum, we remain innocent till proven guilty. I think next week about 88.5 will be important. This, the lows from Thursday in all these markets will be an important level to measure the health going forward against. But we've got a strong market, and there's just no reason technically to short it. You can think of all the reasons you want in the world fundamentally, but it doesn't matter. When there's buyers in the market, that's what is important. The Russell 2000 had a little bit of trouble this week at about the 113.5 area, and you can see that this was an important area in the past, that back in January it was an important support level. Once that support broke, it became resistance, and then we got back above it here this week. So we've rallied from 108 to 114. We've seen very good percentage moves this week in the equities, and common sense would say that after a large rally like this, they need to settle down a little bit. But again, with primary trends still higher, it just doesn't make sense to be a short seller for anything more than, in my opinion, I always say, more than a day trade. That is, you don't want to trade short for more than a day trade, not while we're above a rising 5-day moving average. And we were above that 5-day moving average all week this week, so there was no reason to be short in here, in my opinion. The semiconductors broke out to new highs as well, so this market staged a real nice V reversal. Not really a very common type of occurrence, but we've got these buyers that have just been very consistent in the last 2 weeks, and we've got this trend line that some people will take note of next week. But again, breaking a trend line doesn't mean that this trend will reverse, and it's not a reason to sell short if that's what you're looking at it for. Instead, it says the rate of ascent may have slowed, and it might need to distribute a little bit or digest these gains through time. Either way, the important level I think for next week is that we really want to see hold is about 42.25. The semis have been very erratic here for the last 6 months or so, but the buyers are in control, and it's innocent till proven guilty, and same goes true for the financials. Now, the financials didn't recover quite as much. If you look at the percentage, we're only up 1.6% for this week, and we're still down 1% year to date. And looking at the chart, you can see that this is the important area of prior in a prior important area, because it was resistance over here and then support. So this is our potential band of resistance now, and we're at the top end of that at about 2160 up to about 2175. That's the key band of resistance that we need to see taken out for this market to really, for the buyers to take control. It's impressive that the pullback on Thursday held at this prior little resistance level. So 2135 is important next week. If we were to pull back and then break through this level, that would be very bullish, I think, for the financials. But longer term, they're obviously still in a very strong uptrend, and that's really what matters here. So pay attention again to where we are in relation to these moving averages and what the direction of those moving averages are, and know what time frame it is that you need to focus on for your particulars. I talk obviously from a shorter term standpoint, and I have the luxury of being able to change my mind often, but not too often, because again, what we want to do is trade in the direction of the 5-day moving average for swing trades. And as it's lower, that is, the 5-day moving average is lower, then we want to look at it with an eye of suspicion and look for select shorts. And as it turns back higher and takes out prior levels of support and resistance, then we get more bullish with it. It's a matter of listening to the message of the market rather than imposing our wills and our beliefs on what we think should happen. The bonds this week did back off a little bit, and we spoke last week about how the declining 200-day, well, first that we had such a strong rally, and that it got up to this declining 200-day moving average, and I expected that it was likely it will pull back down towards 105 and kind of settle in there a little bit. I think the same could be said for gold, that gold has had a spectacular run this year. Again, year to date, we're up 9%, 9.5%, and we've got this declining 200-day moving average. I would expect that next week we begin to pull back down a little bit further, probably into about this prior resistance at about 122.5 to maybe 123.5. So, the tide may be turning in gold, but still the longer term trend with a declining 200-day moving average still has to be looked at with an eye of suspicion there. Shares of Apple continued their real nice run here, and what we saw this week was we got right up to that 50-day moving average. The 50-day moving average is at 543.32, and it's not necessarily to be looked at as a specific level where it is, where we expect to to find resistance, but we had a real strong run. And if you take a look at the highs from December to the current low here, on a Fibonacci retracement, we retraced almost exactly 61.8%, and we came in and kind of closed this gap, and we've got the 50-day moving average. So this looks like an area to start to be very careful if you are participating long in Apple, that there's no sign that the sellers are taking control, but it's an area where we have the potential for the sellers to maybe, or the buyers to kind of back off a little bit and sellers to come in and take some profits, and perhaps we could see some pullback in Apple next week. But it's not, it's definitely not bearish. It's in a good trend here. So that'll do it. I have I'll be in New York City on Monday and Tuesday to talk at the Traders Expo. On Monday, I've got a panel with hosted by Phil Perlman and J.C. Peretz. Who else is there? Ryan Detrick and Greg Harmon. So all those guys will have a good talk Monday at 10:30 a.m. Eastern Time. And then on Tuesday, I've got a presentation about short sales. Short squeezes, and that'll be at 8 a.m. Eastern. So that will be live broadcast. Both of them will be live broadcast. So make sure you go to alphatrends.net to take a look for the links. And I hope everyone had a good week and have a good weekend. I'll talk to you next week. Thanks.